Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go until the closing bell, and tech stocks leading the surge in markets here. Jared Blickery joining us to break down all the headlines. Jared, what are you seeing in the markets?
Thank you, Josh. Well, we're seeing an outsized day, not in the Dow. We'll get to some of the NASDAQ stocks and sectors in a second. But just take a look at this. This is the intraday price action in the Dow, briefly red towards the open, but still up just shy of 0.5%. But the NASDAQ, meanwhile, this is a composite. You can also take a look at the NASDAQ 100. Each of those up about 2.5%, having their best day since May, so about 6 months. And if you remember me quoting a stat, I quoted that exact same stat sometime last week, but we lost some steam into the close, so it didn't hold. Nevertheless, we're looking at some decent-sized gains, including in the S&P 500. That's up about 1.5%. Russell 2000, indicative of the small caps, that is up just a little bit more than the S&P 500. So that is your stock measure of indices here. Let me just get to some of the bond market action. Take a look at the 10-year T-note yield. That is down another 3 basis points to 4.04%, getting pretty close to that big psychological level, which we've seen a few times this year, but this is basically very close to the lows of the year. Just remember, a few months ago, rising long-term yields were a problem. No more. Here we have the 30-year. That is down 4 basis points to 4.68%. Far off of that 5% and 5.1% mark that was causing some headaches. US dollar index, we're going to call that relatively flat right there. And we'll get to Bitcoin in a second. First, let's check out the sector action. Tech sector up 2.4%, followed by consumer discretionary up 1.5%. Those are the only two outperformers. But in third place here, we got communication services. So the mega cap sectors, the Mag 7 really leading the way here. Staples, energy, and real estate rounding out the bottom. Staples down by 1%. That is a defensive sector, so really some bullish price action that we're seeing here today. Take a look at this board here. You're going to see Alphabet to a record high. That's up 6%. That's a big amount for such a large stock. Apple on track for another record closing high of 1.7%. Tesla up nearly 7%. Meta up 3.5%. Some of these names have been beaten down recently, namely Meta, but we're seeing some good rebounds today. Here are the semiconductors. We got Lam Research up 5.5%. So is AMD. Micron up 7.5%. And some of these names, Western Digital up 8.5%. Meanwhile, in software, not as impressive, but still seeing a lot more green than red. And some of the smaller names really, really impressing me here. This is the ARK Innovation Fund. A lot of disruption here, but let me just show you the speculative fringe of the market. These are my meme stocks, and we're seeing a lot of green. Carvana down up 7%. Hood bouncing back after being beaten down up 6.5%. Coinbase up almost 7%, which leads me, as promised, to crypto, where we got Bitcoin up 1.15% over the trailing 24 hours, but some of the other coins here doing really well. Here's Ripple up 7.5%, Ethereum up 5%. So a lot of the bearishness that we were worried about last week just kind of shaking off today. We'll have to see if it lasts into the close and then into the weekly close here, Josh.
All right, thank you, Jared. Well, Bitcoin eyeing a bit of a turnaround here. The cryptocurrency moving higher after dropping more than 30% from its peak. Bitcoin ETFs on track for their worst monthly outflows. Investors pulling out $3.5 billion so far this month. Joining with more, we got our very own Ines Ferré. Ines.
Yeah, Josh, and as you were just mentioning, we are seeing Bitcoin rally, and as Jared was mentioning, we'll have to see if this is a sustainable rally or not when it comes to Bitcoin. Just to back up, the entire crypto market has lost about 29% of its market cap value since October. That sizable pressure down that you saw on Bitcoin is down about 29% from its all-time high in October. That's counting in today's bounce that we've seen and the bounce that we've seen since Friday. And this is because of the dovishness that's come out of some Fed officials about a possible rate cut in December. But the question is whether or not this is a bounce which will be long lasting. And there are strategists that are cautious about this because 10X Research doesn't think that this bounce will continue on. They believe that it will fade going into the FOMC meeting. And that's because if it's a 25 basis point cut, that's considered to them a sort of a hawkish cut. If it were 50 basis point, or if there was a lot more dovishness coming out of the Fed, then it would be a different story. Sean Farrell over at Fundstrat on Friday was just questioning whether you'd see a meaningful leg higher if you still have AI angst in the equity market, because if you see that turning around, then it would be hard for Bitcoin to outperform. So it's sort of a wait and see. But what could be catalysts that send Bitcoin and the crypto market in general higher in the future? Look, definitely Fed dovishness and also the Clarity Act, but that won't be likely this year. And then whether or not strategy makes it into the S&P 500. By the way, strategy today is up, and this is the first time in 6 weeks that strategy has not announced a purchase of Bitcoin for the last week. So analysts, investors were waiting to see what strategy would announce today, and so far there's been no announcement about Bitcoin purchases over the past week.
All right. Interesting. Ines, thank you. Appreciate it. Well, as Bitcoin looks to catch up with the broader market rally, could this be a sign that investors have shaken off their jitters, or could we see more volatility ahead? Joining me now, I have Michael Kantrowitz, Piper Sandler Chief Investment Strategist. Michael, always great to see you. Let's start there, maybe with Bitcoin, Michael. Just continue that conversation. I mean, sure. Up a bit right now. Of course, that's after a big drawdown. I'm curious, as you've been watching Bitcoin, what do you make of the moves you're seeing there, Michael? What does it tell you or suggest to you about broader risk sentiment?
Yeah, Bitcoin to me is really just trading as the kind of the tip of a beta trade. It has increasingly been correlated with measures of financial market risk like credit spreads. And if you look back the last 3 or 4 years in periods where markets are going up and credit spreads are tightening, which is a reflection of the market pricing out macro risk, Bitcoin typically does really well. And when we have the opposite of that, which is credit spreads widening and investors concerned around anything from AI to the Fed perhaps being a little more hawkish, assets like Bitcoin, which don't have earnings and are really high beta securities, tend to be hit the hardest. So there's nothing to me from a macro perspective or market perspective that I'm getting from Bitcoin other than it's just the highest volatility asset in the market.
Mike, we had other strategists on recently who were watching Bitcoin very carefully, and it was a cause of, I guess, near-term concern to them. In part, it sounded like they were saying, well, do I look for folks to keep selling stocks to cover losses in crypto? And I'm just curious how you're thinking about that dynamic.
I've heard those conversations, and I'm sure there are, of course, other influences. But again, from my perspective, it's hard to disaggregate Bitcoin's price action from just general market angst. So what will be interesting going forward if we do see at some point a disconnect between Bitcoin trading as a high risk asset. I think that those conversations with things that are specific to Bitcoin then become much more interesting. But so far, really, the last few years, we haven't seen that. But I wouldn't be surprised if that's been going on, because that tends to be an asset class where you've got a lot of FOMO, a lot of momentum, and a lot of leverage being used.
You mentioned AI, Michael. One interesting move there, talking about big tech and the AI trade, just some of the divergences we're seeing here. Like over the last month, for example, Alphabet rocket ship. Meta, though, whacked. Oracle whacked. And I'm just curious what you make of that rotation. What perhaps some of these moves suggest to you, Michael, more broadly about how that mega AI trade and trend perhaps could be evolving here?
Well, it's been a really fast-moving story. For example, a chart in the late 90s, what worked really well back then was buying stocks and holding them for 12 months in terms of a momentum strategy. Whereas over the last 2 or 3 years, you've had to have a much faster churn in a momentum portfolio to see better gains. So 3-month momentum strategies have worked better. So I'm not sure if that's a reflection of the story evolving faster or new entrants to the market, evolving faster, investors, bidding up one asset, one of the Mag 7 or two of them, and then rotating into what's been kind of left behind. But certainly, we've seen a lot of rotation over the last couple of years within the groups. And I think investors are just always looking for where the next relative positive data point or piece of information is going to come from. So, I'm not a tech or AI expert, but from a market perspective, some of the AI stocks too are not very expensive. I believe NVIDIA is at the lowest valuation of the last few years, and there's only been a handful of Mag 7 stocks that have actually seen PE expansion this year.
You also know an interesting trend I want to call out here, Michael. Large cap value. You noted lowest beta, safest haven. What explains that shift?
Yeah, well, part of it is the way the index is constructed. There's a lot more counter-cyclical and stable industries in the S&P 500 large cap value index nowadays. And so if you think about the last several years, really going back 10 years, there's been a huge outperformance of growth stocks. There's been a lot of new companies, a lot of new innovation, and those names tend to fall into the growth index, of course. And what's been left for large cap value has really been these very mature, stable companies. Think of the Dow Industrials, where at least some of the more industrial older names, the larger banks that are much more mature companies that are in there, and their business lines, when you aggregate up the volatility in their fundamentals, have just become much more stable. So we've just highlighted that as investors looking to diversify out from the AI basket and looking for some stability to offset some of that volatility. Large cap value is a good place to look for some high quality, more stable names without getting overly defensive in the market.
I want to talk to you about the Fed too, Michael, get your thoughts there, because so we got the meeting next month. Okay. And we had some questions about whether you were going to get a cut. It was a coin toss. And all of a sudden, we saw these jitters in the market. Now, odds improving, we think we're going to get a cut. And hey, I got green across my screen. I'm wondering what that suggests to you.
Yeah, well, there's been a lot of narratives in the last month and a half or so as the market has pulled back and breadth has deteriorated. It's concern around the low-end consumer. It was the absence of data during the shutdown. And of course, it was the more hawkish tone from the Fed, starting with Powell's comments in his last press conference in October. And so when we look at the data we've gotten in the last several weeks, the employment data was okay. The unemployment rate ticked up, which I think is an important part of what Powell looks at, and certainly would continue to warrant a more dovish tone. One of the pieces of data, and we're not getting that much more macro data before the Fed's next meeting on the 10th. On the 9th, I believe we get the job openings data, or JOLTS data. And we haven't gotten that data in a few months now. And there are other data sets like Indeed. They publish that data, which suggests we'll probably get another soft report from the JOLTS data. So that could kind of cement a rate cut, in my opinion, the next day. And I think the markets will continue to pay attention to that. But when we look at all the narratives that have been driving the market, the one we can quantify is there's a pretty strong inverse correlation between the stock market breadth and whether or not we're going to get that rate cut. And on Friday and today, odds were as low as, I think, somewhere in the mid-20s, and they're up to 79% as we speak right now for a cut in December.
So bottom line, Michael, I'll get you out of here on this in terms of just a takeaway for investors, against this backdrop, this environment, when you're screening for opportunities, Michael, broadly, what are you screening for?
Right now, looking into 2026, where we see, and this is going to be probably a bit out of consensus, better housing activity, better manufacturing activity, better cyclical activity. And it's largely a result of the last 2 years' softness in jobs, stabilization, and decline in interest rates. We're looking for more value and cyclical opportunities next year, where we can see the biggest increase in where current expectations are and where we think the fundamentals will end up. So we expect a better, broader market next year, coming on the back of that better macro data. So we're looking more cyclicals, more value. And I would say simply, we think value will outperform growth next year, which will be the first time in a long time, really since 2021.
Michael, always great to have you on the show. Thank you, sir.
Yep. Good to see you.
Coming up, we get a wrap on the latest Fed speak. That's next on Market Domination. President Trump speaking out after a call with his Chinese counterpart, Xi Jinping. Fed correspondent Jennifer Schonberger is here with more. Jen.
That's right, Josh. President Trump said he had a good call with Chinese President Xi Jinping earlier this afternoon. On that call, President Xi officially invited President Trump to Beijing in April, an invitation that the president has accepted. The president reciprocated, inviting Xi to the White House in an official state visit later next year. Now, both leaders discussed a range of topics on that call, including purchases from China of U.S. soybeans and other farm agricultural products, as well as the Russia-Ukraine war and fentanyl. The president posting on Truth Social earlier this afternoon, quote, "Our relationship with China is extremely strong." This call was a follow-up to our highly successful meeting in South Korea 3 weeks ago. Since then, there has been significant progress on both sides in keeping our agreements current and accurate. And during those talks, recall that China agreed to resume purchases of U.S. soybeans and other agricultural products, as well as lift those extra export controls that they had put on critical rare earth mineral exports to the United States. They also agreed to scale back any materials used to make fentanyl that are exported to the U.S., which brought the U.S. to bring down tariffs on fentanyl in China by 10%. Josh.
And Jennifer, while we have you, the Fed also in focus, of course, the odds of a rate cut now even higher. What is driving that move?
Yeah, moments ago, we actually learned that San Francisco Fed President Mary Daly says she now supports a rate cut in December. She told the Wall Street Journal in an interview this afternoon that she sees a significant deterioration in the labor market now that is going to be more difficult to tend to than a flare-up in inflation. Now, her comments coming just after this morning, Fed Governor Chris Waller, who is a voting member, expressed support again for a rate cut in December, also saying that he has concerns about softening in the job market. He believes that the stronger September jobs report that we saw of 119,000 will actually be revised down by 50 or 60,000. Now, when it comes to next year, he says the FOMC is probably going to take meetings or interest rate decisions meeting by meeting. But all of this goes back to what we heard on Friday when New York Fed President John Williams really changed the sentiment in markets, saying that there is room for a cut in the near term. And since then, we've really seen odds shoot up this afternoon. Investors placing bets about an 80% chance for a rate cut next month. Josh.
All right. Thank you, Jen. Well, the waiting game on the Fed's December meeting, plus the slow trickle of delayed economic data weighing on bond investors today. The yield on the benchmark 10-year hovering just above 4%. Joining me now is Gunit Dhingra, BNP Paribas head of U.S. rate strategy. Gunit, always great to see you, especially on set. Let's start with the Fed meeting next month. Will they cut? Should they cut? What's your take?
Yeah, thanks for having me on, Josh. We at BNP have been very clear. I think the December meeting was always going to be a rate cut meeting. One thing we have seen with Powell in the past is he tends to go in episodes. So taking a break in December would probably have meant that there probably won't be more cuts down the line. So December had that sense of continuity from September and October. Plus, I think the economic justification, at least to the extent that Powell wants to focus on the labor market, is there. The unemployment rate has ticked up by 0.3 percentage points in the last 3 months alone. And we think the economic rationale is there. At this point, we do think they have the votes as well. So we are firmly in the December rate cut is happening camp.
Well, what are the risks of cutting, though, into this time where, listen, the government shutdown's over, so you would expect a snapback. the Trump tax cuts, the big beautiful bill. What are the risks we should think about there?
Yeah, so I think you're right to point out those risks, because right now, even though the rate cuts are going to happen probably in December as well, I think markets are not convinced that we actually need those rate cuts at the same cadence. So we've talked about this gap where what the Fed will do and what the Fed should do has been different for quite some time. Inflation numbers are running close to 3%. I think the risk also is that people think that rate cuts that happen with dissent, which is also a big feature of rate cut policy these days, particularly next year, where I think a lot of the hawkish voters on the committee become voters. Those dissents, I think, are going to make it very difficult for the market, particularly the 10-year point, to follow off these rate cuts. So the Fed can cut rates in December, but we don't think the 10-year rate's going to follow that.
Yeah, I wanted to ask about this. Well, just sort of this concept you brought up in a recent note, Ines, about this kind of fractured Fed. And your team pointed out, listen, it's a rowdy, disorderly process. So rowdy, disorderly. I mean, how does that dynamic, just walk us through how you think that impacts the easing cycle going forward.
Yeah, so I think, look, historically, a rate cut, you go back in history, it's hard to find meetings where rate cuts there are more than one or two dissents. Maybe three once in a while, but that's very, very rare. In fact, I went back and looked at the history of dissents for the last 25, 30 years. Very rarely you get those dissents. Right now, the way these public speeches are going, it is very possible next year you will have possibly 2-3 dissents, almost on an ongoing basis. Some dissents for possibly bigger cuts, some dissents for possibly less cuts. And so I think these fractures in the committee are becoming more and more prominent. And next year, this is why I think the market's going to struggle to price the lower rates, because the cuts won't be convincing in light of those dissents.
On the labor market, I thought you all had an interesting point of view. You say job creation declines. You guys say due to immigration policy, not cyclical weakness. So does that mean the softening that our central bankers expect might not show up?
Yeah, so I think the immigration policy has been part of the reason why the break-even rate of job growth has been much, much lower. A 50K job print in this environment is probably enough to keep the wage levels on an upward trajectory. So right now, what's happening is we think the unemployment rate, which cancels out the supply and demand of labor, that unemployment rate has become the judgment factor on which you judge the labor market, not the number of job gains. And that's why I said when unemployment rate has gone from 4.1 to 4.4 in the span of 3 months, I think that is economic justification for now for the Fed to keep cutting.
Switching gears, there was a good piece in the Journal, Gunny, right in your wheelhouse, and I want to get your take on this. The piece is the headline: "Flood of AI bonds adds pressure on the market." I don't know if you saw this. They said here's a number: since the start of September, they say the AI hyperscalers, those tech giants, they have issued nearly 90 billion of investment-grade bonds. They say that is more than they had sold over the previous 40 months. What should we make of that as investors? What did you make of that?
Yeah, no, I think that is a very interesting dynamic. And I think what that tells you is a big theme, I think, for 2026, particularly for me as a rates watcher, is AI is becoming more than just a capex story and more than just an equity market story. It's going to bleed into the rates market via these technicals. It's going to bleed into the rates market via the macroeconomic impacts. Specifically on the technicals, if you think about the issuance numbers that you mentioned, those are mind-bogglingly high numbers.
Totally
I think the issuance of that magnitude, we've heard about this idea of overcrowding or crowding out. In the past, the treasury market was crowding out the private sector. It's quite possible next year it's the private sector hyperscaler issuance that might start to crowd out the treasury market. And so that's one more reason, among a litany of reasons, why the long-end rates will struggle to go down in 2026.
So let me get you out on this. Your clients come to you, they say, where's the opportunity in 2026? What are you telling them?
Yeah, so I think short-term rates probably going to hang out here, maybe a touch lower, maybe a couple of cuts in 2026. But I think longer rates are going to go higher. We are thinking about getting close towards 4.5% next year.
Gunit, always great to see you, especially on set. Thank you, sir.
Thank you.
Coming up, Google is leading the surge in big tech. We're going to bring you the news behind this move next on Market Domination. Now time for some of today's trending tickers, starting with Alibaba. That stock seeing a jump as the company's AI app drew more than 10 million downloads in a week. Chinese e-commerce company disclosing the number for its Qwen chatbot in a WeChat blog post. This momentum signaling potential competition for OpenAI's ChatGPT, which has over 800 million weekly active users as of September. And Micron getting a price target lift at Morgan Stanley, raising its target from 325 to 338. Analyst Joseph Moore reaffirming his overweight rating on the stock. Morgan Stanley noting that demand for memory chips is strong and doesn't believe additional chip making capacity will be able to meet demand for several quarters. This comes as Micron, remember, also recently saw a price target lift over at UBS. And lastly, Booking Holdings sees an upgrade at Bank of America, firm lifting its rating on that stock from neutral to buy while maintaining its price target on the stock. The firm highlighting that the risks from Google and OpenAI's agentic tools are overdone. B of A adding that Booking Holdings is in a good position for AI deals given supplier and consumer positioning. Well, Alphabet is back on offense in the AI race. The Google parent company launching its Gemini 3 chatbot with resounding success among investors and leapfrogging rival Microsoft to total market cap. For more, we're bringing in now Yahoo Finance tech editor Dan Howley. Dan.
Yeah, that's right, Josh. This is a big move for Google. Really, they announced this Gemini 3 model last week, and since then it's kind of picked up momentum when it comes to executives. Mark Benioff at Salesforce basically saying in a post on X that he's just going to leave behind GPT now and just go with Gemini. That's a huge vote of confidence for this model. And in different benchmarks, it appears as though Gemini 3 bests ChatGPT, or rather GPT-5, in a number of areas. So this is really helping to boost the company's stock price because it more or less shows that, it's not necessarily a one-horse race when it comes to these kinds of things where, ChatGPT, or GPT rather, had the lead for a while. And now Google's come out and said, all right, well, we're going to take it back. And so it's good at everything from, your reasoning to things like coding, which is actually incredibly important in this area because a lot of companies end up using these kinds of AI models for some coding capabilities. And so the fact that it's able to outcompete GPT-5 there is hugely important for Google. And so, bottom line, investors like this, and it shows that those investments are paying off, at least as far as advancements in the AI models. Now, as far as what that means for their actual business and revenue, we just have to see.
And also, Dan, you wrote about Anthropic's latest AI model. What's the news there, and what does that mean for kind of the broader competitive landscape?
Okay, well, Gemini 3, that was in the lead for a few days. And now we have this new version of Claude from Anthropic, Claude 4.5, that Anthropic says is better than Gemini 3 and Pro and GPT-5. And so, it really is this kind of cycle where you see one company come out and say, look, we've got the best model. And then the next thing is, oh, we have the next model. And then the next, it's kind of this cycle. So no one is ever really on top. As I said, it's not a one-horse race. We keep seeing all these companies come out with new models, and then, they'll best someone as far as coding, someone will best someone as far as reasoning. And so, I think we spoke about this last week when Gemini 3 came out, is that it really comes down to what individual enterprises want to get out of their AI, and then on the consumer side, what you want to get out of the AI that you use. And so, there's no win all be all at this point.
And finally, Dan, I got to get your take on this Bloomberg headline. Apple cuts jobs across its sales organization in rare layoff. It is unusual to see the words Apple and layoff in the same headline. What'd you make of that?
Yeah, it's interesting. This is from Mark Gurman, who basically lives inside of Apple's walls, I think. And, you pointed out that when, talking to employees, the company said that it's a way of kind of streamlining. But internally, he said folks are basically considering this a way for Apple to ensure that its third-party sellers can handle more of the sales heavy lifting. And so that cuts off some of the spending that Apple would otherwise have to do by using its first-party sellers. And this has to do with, governments, selling to governments, selling to school districts, things along those lines. And interestingly, he points out that Apple is planning, or the reporting is, Apple hasn't confirmed anything yet, that they're going to come out with a lower cost MacBook. And so that would be ideal for school districts as well as government agencies. And so you would think that they would want to hold on to those positions, but really looking to seemingly lean more on those third-party sellers when it comes to getting those out the door, if it actually is a product.
All right, Dan Halley, wrapping up all things tech. Thank you, sir. Consumer spending in focus this week as Black Friday officially now kicks off the holiday shopping season. Investors are closely watching more retail earnings on deck. Market Catalyst host, Julie Hyman spoke to Jerry Storch, Storch Advisors CEO, about the outlook for consumer spending.
We're still flying blind because of the lack of government data, but generally what I've heard is it's okay. And you're right. The holiday season really starts off with Amazon Prime Days in October now, and then it rushes towards holiday. There's still a long way to go, however. The consumer has held up very well all year, despite concerns about inflation, jobs, tariffs. There's been a lot of worry, but the consumer has kept spending. The year-over-year growth in the last report we had, which is getting pretty old, was 5%, which is a very healthy number. And I've heard from credit card companies, others, that's kind of where it's holding, which is darn good.
And how do you sort of square that, Jerry, with the negative vibes out there, right? For lack of a better word, right? We keep hearing about the K-shaped economy that lower and even middle income Americans are having a tough time right now, right? We see the sentiment surveys; those haven't stopped, and those aren't great. So how do you sort of square that with the spending?
Right. Well, great question. But everything's relative. I don't really think there's a K-shaped economy. People keep saying that. I'd like to put a stake through the heart of that. K implies one part is rising, another part is declining, the bottom part of the K. That's not what's happening. All the parts are still rising. It's just, of course, the higher income areas with a growth in the stock market are rising at a faster rate. The lower income areas are rising at a slower rate. But they're still rising. Wages are still exceeding inflation. It doesn't mean people aren't feeling stress. The cumulative effect of years of inflation definitely weighs on people. It doesn't mean lower income strata aren't spending more on necessities instead of fun stuff. But they're still spending when you really look at the data, at what's actually going on. So that's why I feel pretty confident the result's going to be pretty good for the holidays.
Jerry, there is a word that I don't think I heard before the past few years, and that word is choiceful. And that seems to be the word of retailers over the past couple of years, that consumers are being more choiceful, right? That they're being, I don't know how else you would say, more particular, I guess.
I don't know. I think there are winners and losers. There always have been. People are saying that. It's funny how you hear about all these terrible things from the people that aren't doing well, but then, Walmart is thriving. They're doing, fundamentally, excellent on every front. TJX keeps doing well. Costco keeps doing well. Amazon keeps capturing market share. There are certainly people who are losing, like Target, is one that's absolutely losing. Then you see someone like Gap. I saw you flash that up on the screen. Here you have a new CEO come in. This is a company a lot of people have given up for dead. They're thriving. They're doing fantastic. Well, what does that mean? How is that choiceful? Maybe they're just choosing the stuff they want to buy, not going to the retailers or trying to sell them stuff they don't want to buy. There is a theme of value, and that's been true probably for a decade, where retailers provide great value, have been capturing market share. And again, Costco, Amazon, TJX, and Walmart are the giant winners. If you really look at the numbers, they have captured just massive market equity capitalization share of all retailers, as well as market share among consumers. Not even, TJX, this is the smallest one of those. Their market cap is $162 billion. Target's only $39 billion. It's like, wow, things have changed. And that didn't happen in 1 year.
No, that is an incredible perspective on that. And everybody, all the stock pickers within retail who we talked to lately love TJX. I got to say, Jerry, that's a name that keeps coming up again and again. What do you think? What else do you think people are going to be buying? What other trends do you think we'll be seeing? Is it going to be like apparel, or like what gifts are going to be popular, do you think, or what categories?
Well, I do think apparel is going to be popular. Obviously during the pandemic, people held off. Apparel has been stronger than maybe it should have been. It's one of the places that has the greatest inflation, by the way, from the tariffs, because most of it is imported. Yet people like to buy apparel. There's probably still some pent-up demand there. I think that's an area that's going to do better than it has historically. don't fool yourself and think it means all specialty apparel places are going to do well. Only the ones who have people want, like Gap as an example, or Abercrombie or someone like that. Don't think that means department stores are going to do great. People are shying away from department stores. They may do better than very low expectations, but they have been, increasingly shrinking into irrelevancy to consumers. That's not where they need to go anymore. If they want a department store, they have one called Amazon. So don't conflate apparel with all apparel places. Apparel in places people want to buy what they're selling, like the app.
I got to tell you, my 13-year-old told me clothing is not a gift. But that's probably just me. And then,
well, they never think that. They want video games and toys.
Of course. And then I'm also curious about the interplay between online and in person at this point, Jerry. Am I going to be able to get a spot in the mall parking lot on Friday, or are we still going to see a lot of people going into those stores?
Well, what's happened is all the Black Friday deals are almost all of them are available online. And so it almost starts Thanksgiving Day before any stores are even open. So Thanksgiving Day is huge online. Black Friday is huge online. And then, of course, you go right into Cyber Monday weekend, and Monday is huge online. So a lot of that volume, clearly, of that sort of urgency has shifted online. We were sitting there hovering over the keyboard trying to get that deal. There's no doubt about that. So you're going to see little bursts of energy at the stores when they have their opening specials, doorbusters, things like that. Then it's going to die down, and the afternoon is going to get busy again. It really will, because people are bored. Those who don't want to watch, instead of the football games, they want to go shopping. People will be out there. So I think you're going to have a busy Black Friday, but it's not what it used to be, because online has stolen a lot of the immediacy from the day.
Coming up, we zero in on the competitive landscape for Walmart as the retailer looks to grow its tech capabilities. Walmart and Target have long been seen as close competitors, but as Walmart makes more strategic tech plays, the retail battle may be shifting and bringing Amazon into play as an emerging viable comparison. Here to discuss, we've got Aptus Capital Advisors Head of Equity and Portfolio Manager, David Wagner. David, great to see you. So we'll compare and contrast the two, but I'm curious first, David, just to get your take on these specific names, because I know you have takes. Walmart, start there, reported. You saw the reaction. Investors clearly like what they had to say, David. You talk about its offense strategy. So the way they're leading into marketplace, Walmart Plus, automation. How confident, David, should investors be, in your opinion, that the kind of step up in CapEx that you're calling out here, that's really going to lead to meaningful top line growth here in the quarters and years ahead for them?
Yeah, Josh. Well, one, thanks for having me here. I mean, Walmart is one of the best retailers in the world because over the past few years, they've been laser focused on technology and AI implementation. But more importantly, they haven't been reactive like some of the other retailers out there, like, say Target. They've been more proactive and, more importantly, predictive. I mean, they're implementing predictive analytics really in every single part of the consumer journey, whether it's from, shopping to media targeting, that, really gets me optimistic about this stock moving forward in the future. I mean, they've really just, put Target in the rearview mirror. And you're exactly correct. I think the better comparison now moving forward is comparing them to Amazon. But, at the end of the day, what they've been able to do from the supply chain ecosystem at Walmart is really making the complete difference relative to any other peers out there. And that's why I'm actually okay buying the stock at 36 times forward earnings because of that technological advantage.
Yeah, you note, David, how Walmart is becoming a tech-powered retailer. Should it be valued like one, David?
More so, absolutely. I mean, their 5-year historical, next 12 months PE valuation is probably closer to, say, 25 times earnings. That was more in parity like the other consumer staple stocks back in the day, like Procter & Gamble. They're trading at 36 times forward earnings right now. Josh, I actually love the move, though I was very surprised by it when they decided that they're going to move from the NYSE over to the NASDAQ, but it makes complete sense. To your point, they've transitioned away from the normal corporate retailer and more to that, technological hub for retailers moving forward into the future. And by going to the NASDAQ exchange, that gives them the option availability to join the QQQ. And honestly, me and you both know outside of, S&P 500, there's so much flows heading towards the Qs, and it would only back their valuation from a capital front.
All right, so that's Walmart. Let's get your take on Amazon here as well. You talk about AWS being in last place in AI and ask, does last place matter? What's the answer, David?
I don't think last place matters whatsoever. I mean, the pie of AI and cloud just continues to expand. Whether in their last place, their share continues to grow. I would say, Josh, I think that these AI fears are definitely overblown. Yes, they're only growing AWS at, say, 20%, while Azure and Google Cloud, they're growing closer to about 30%. I honestly don't think last place matters because we just nitpick this data way too much. I mean, if you zoom back and look at a 10,000 foot level, AWS just had their second best quarter ever for net new dollar growth in history. And plus, AWS relative to their other peers, they've been a little bit more capital constrained over the past few quarters. And those constraints, well, they're easing to a point right now where I would expect AWS growth to grow more in Q4. So, Amazon as a whole, I love the retail side of the business. That's where you get some operating leverage. And then when you look at the AWS side of the business, it's definitely the call option that can continue to make the stock work over longer periods of time.
What would you say, David, your biggest risk is to that buy you've got at Amazon?
I think what the bears would be saying out there is that, this AI adoption, like look at the news that came out with Gemini 3 this morning that, obviously Anthropic is one of the big investments for Amazon. Maybe they're, also in last place kind of in this chat GPT advanced computing narrative that I would say that the bears are saying that Amazon on the retail side could lose out on some ad spending as you can get some more efficiencies through ChatGPT where they haven't really, penetrated from that angle. And I think that's really what's been the overall overhang on this stock year to date. I mean, the stock's up, just like 1% year to date. Like it feels like the market loves nitpicking on the winners and the losers of AI. I think they're all going to be winners at the end of the day. So I think that ultimately these bears are going to be proven wrong.
So we reviewed Walmart and Amazon. I'm curious, how would you sort of compare and contrast those names, David?
Walmart and Amazon. I think, short term, I think Walmart has the edge over Amazon for two reasons. One being, the new induction potentially into the QQQ. And the second one also, what we just talked about, Amazon is just battling this, AI identity crisis. But, I think from a valuation perspective, they're almost trading in parity. From a technological advancement side, I mean, they both love to, invest in AI tech. I would say for both of them, they tend to do better when they're harvesting margin rather than investing. That's something I've said for quite some time, that these stocks tend to do better when harvesting than investing. They've all invested, quite a large, substantial amount of capex over the past few years, where I think you're going to get even more of this margin expansion from an operating leverage perspective, working for both. But if I had to choose one at the end of the day, I am taking Amazon over Walmart. I like the valuation of Amazon at 30 times while Walmart's trading at 36 times. But I don't think you're going to be wrong choosing both of these stocks right now.
What about, just to throw another name into the mix here, Walmart, Amazon, how about Target? What are your thoughts there, Dave, with the stock down about 40% year to date?
I wish I could just say no to that answer and leave it there because it's just been so difficult to like Target for quite some time. I just see, the near-term benefits are very limited moving forward because, the frequency and discretionary categories for Target, they just softened on a 2-year stack basis. But my main thesis is that, the traffic recovery and this discretionary demand would just remain a gated factor into some type of sustained re-rating, even when they're only trading at 11 times forward, Josh. I mean, for Target, if I were to be a bull, I'd want to be, focusing on the overall margin. But right now, I just expect that to remain very weak heading into 2026 as elevated CapEx and ongoing price investments, they just remain limited. So they're not going to help, margins at all. So, when a stock trades at 11 times forward earnings, I think any incremental news could be very positive for the stock from a price standpoint. I would probably be fading that just because there's so many structural problems with the stocks. And it all comes back to the point, they've just underinvested in their technology for quite some time. Unlike Walmart and Amazon, we just talked about that. They're just going to be left in the dust.
David, we'll leave it there. Thank you for your time and those picks, sir.
Thanks.
Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.